Rick Rule for the Rule Classroom and Rule Investment Media, sponsors of the Rule Natural Resources Investment Symposium, July 7 through 11 in Boca Raton, Florida, or from the comfort and convenience of your own home via live stream. In either case, you will be exposed to 50 hours of programming in 4 days, more than you can possibly absorb. To that end, the conference recordings will be available for you for a full 12 months. But also to that end, we're doing pre conference interviews with all of our major speakers and all of our exhibitors. Today's interview, the second in a two-part series, with my longtime friend, Jonathan Goodman, CEO of Dundee Corp. As those of you who listened to the first interview know, I have been a shareholder of Dundee and the predecessor, Dundee Bank Corp, for 3 decades now. Really useful for me to enjoy the profits generated by the Dundee without having to do the work that the Dundee people do on my behalf. This is a classic merchant bank, a group that does wonderful technical due diligence, mobilizes capital, and utilizes that capital to support teams who grow very big businesses, cashing out after either everybody else's cashes out and there's a transformation, or else after the value that they can contribute is less important to the success of the whole. Jonathan, first of all, thank you for 4 decades of effort on behalf of investors, particularly myself. And thank you, too, for your ongoing sponsorship of the Natural Resources Investment Symposium.
Thank you, Rick. We're proud to be associated with you guys.
What I'd like to do now is talk about the process of merchant banking and talk about it in the context of investments that you've made in the past. Talk about the due diligence process, talk about identifying the need, talk about providing adult supervision for entrepreneurs who are occasionally in need of adult supervision, and then talk to me about how the exits work. Give us some real examples from past successes and failures, if that's germane.
Sure, man. The easiest one to talk about first would be Reunion Gold, and Reunion Gold is the entrepreneur is Dave Fennell, and many Canadians remember Dave. Older ones, if they follow Canadian football, I think his nickname in the Canadian Football League was Dr. Death, which scared me at first until I got to know Dave, who's become a friend over many years. He's a gentle giant and a very sweet guy and a very, very smart guy at that. But he's a pure entrepreneur. I mean, I used to joke Dave has 100 ideas a day, and 2 of them are brilliant. You just have to sift through a lot to get them. But he's a very creative mind. And we were investors in Reunion Gold and got to a point of almost what I would call total frustration. And we actually sat down, and Dave wasn't even in that meeting. It was with his chief geologist, Justin Vandertoom. And I've known Justin for a long time because he used to work for me when I was at Dundee Precious Metals in Serbia. And Justin's a wonderfully talented geologist. And I just turned to Justin. I said, give me a reason not to sell the stock. And Justin started pulling out all of the trenching data that they had on Oko West. And so now we have data to play with. And you start doing, length times width times height. And if you could drill this over 100 meters. And then we got to it, we said, this is really fascinating because they were drilling into saprolite. Saprolite is a technical term for rock that's been weathered. So you don't need to blast it the same way. It's very cheap blasting. You don't need to crush it and grind it the same. It's kind of already been done that for you. So it's very inexpensive to run saprolite through a mill. And you start looking at the lateral extent of it and say, if they can drill this to 100 meters depth, they'd have 500,000 ounces of gold that would be very low cost. And, that was kind of the work that we did to convince ourselves that, we knew there was potential underneath that for the hard rock and everything like that. But if you can convince yourself that you could have 10 or 20 cents worth of value just by continuing what you've already found, and everything else is free. And that was the catalyst for gave them the money to start drilling. And of course, the drilling found a lot more. And as we kept on doing our own work behind the scenes of kind of multiplying lengths times widths, realizing that they always had a lot more gold than their stock price indicated. It was very easy to keep going, and eventually sold that to G Mining. And I think our total investment at the end of the day was close to $30 million, and I think we cashed out for around $150 million. And I think
Nice. Tell us, Jonathan, something about your due diligence team. You described due diligence as your secret sauce. Tell me something about the chefs. Who's on that team? How did you choose them? How do they gel as a team? What's the process?
Well, the first part of the due diligence team is I need people who are going to protect me from me, because I can get excited very easily. So I need them to keep reminding me that this is a process, it's a scientific ore body. But, I think you start back to what is due diligence, and it means something different to everybody. So to us, we don't just go in there to confirm that if a company says they have 1,000,000 ounces of gold, that there's 1,000,000 ounces. We take that thing, we turn it upside down, we flip it sideways, we look at it, we model it as an open pit, we model it as an underground, we try and look at some of the assumptions that have gone into it, because with 43101 and all of the reporting standards out there, there's a lot of things that you lose in the translation, and those things are often opportunities. So, what we've done with our team is we have a group of financial people, all of whom, myself included, who have CFAs, and then a group of technical people, and I'm also part of the time a geological engineer by training, and Dr. Julian Barnes is a geologist by training. Julian, he's done this for even longer than I have. He was a founder of a company in Australia called RSG Resources, which was a geological modeling and resource firm. He used to do most of the due diligence for Macquarie Bank when I first met him, and so when I bought the assets in Bulgaria for Dundee Precious Metals, Julian was the guy that I used, and I think we started that process in 2002. So I've worked with Julian for a long time, and he's a very creative guy, but also very disciplined and knows how to look at these deposits in ways that I even to this day, he's still startling with me with things that we didn't know in the past. Then there's Adrian Goldstone, who also worked. He joined me at DPM in 2005. Adrian's specialty is twofold. One is project management and project governance, which is a topic that he could talk about for hours on end and very important, but also on environment. He used to run an environmental consulting firm, so he knows all of the environmental issues very well. He woke my eyes up many years ago to the value of ESG and community relationships, and the people that are your detractors out there. They're the ones you want to have a dialogue with, and how to have that dialogue. And I've learned a lot from Adrian. And then we have a young mining engineer in Toronto, Justin Sickard, who is a tremendous, talented young mining engineer, also going through the data, learning from both Julian and Adrian and myself, and at the same time helping us, get a lot done on these deposits. And then the financial team as well. Like the financial modeling also has creative aspects to it.
Let's get back to the companies a little bit. In our last interview, we were talking a bit about Magnum Mining. Let's go back to the genesis of Magnum Mining, and let's talk about your involvement in FNX, which many of our listeners won't know about. Tell us something about the genesis of FNX, what your involvement was, and to be crass, how much money you made for shareholders over the duration of your involvement in FNX.
Well, way back when, I think would have been the early I don't even remember the year exactly. I could find it out, but we met Terry McGibbon, and Terry McGibbon, as you well know, he was a geologist who had worked for Inco in Sudbury and knew the Sudbury rocks probably as well as anyone. And the only one that knew him close to as well as him was also coming with him on this venture, Morrison. And they started a company called, eventually it was FNX. And I think the FNX stood for Fort Knox because it was originally Fort Knox Gold. And he had to change the name because it wasn't a gold company anymore. And he had negotiated the ability to buy 4 projects off of Inco, which is the company he worked for. And you're talking to him, you realize these were 4 projects that, were in, they were his 4 favorite projects on them. And for Inco, they weren't a priority, but for Terry, they were a priority. And, for years, we've always seen, whether you see it in the oil business or you see entrepreneurs take smaller assets out of a larger company and do great things with it, because these, when a big company, you take a Barrick, they have something like 18 gold mines. If you take their 18th most important mine in their portfolio, they don't have their A team on it. And if you take a team that would be an A team in any other company and bring them to that project, they can often do great things. And that's kind of the thesis behind Terry. We saw, a very, very clearly a very skilled and talented geologist with that sparkle in his eyes about wanting to be an entrepreneur, and how he had just negotiated, his 4 favorite exploration projects outside from the company he had worked for 20 years. That's almost like a recipe. And I think we bought 16% of his company to start with. And I know that he worked with, this is back when I was at Dundee, the first round, and we bought it in the fund that was Dundee Precious Metals at the time. And I think we paid 40 cents a share. I think the stock went to 32. I think we got out around $9 a share. We made a lot of money there. And it was a wonderful venture, and he bought these assets that, as he moved on with the drill bit, the market eventually saw all of the assets, and I think they eventually sold the company to KGHM out of Poland for, I think, a couple of $2 billion. The really cool thing about that, and you and I have talked about this before, is that these same assets are now, many of them are part of Magnum Mining, which, we're the largest shareholder of Magnum Mining. We own about 22% of the company. We got involved with their acquisition of the Crean Hill asset, which is a beautiful asset and wasn't part of Terry McGibbon's FNX. But they've just closed and purchased the McCready West mine and the Levack mine, and some other assets off of KGHM. And the really cool thing about the team is every one of these guys worked for FNX. And, Dave Keane, their top exploration guy, worked directly with Gordon Morrison and still does. Gordon Morrison's an advisor to Magna. Jason Jessup was one of the senior guys underground mining at both McCready and Levack, and still knows a lot of the guys that are working there. And he's the CEO of the company now. And what's really changed is, in the old days, the Vale and the Inco was a tough company to do business with. Whereas I think today, Vale and Magna have a great partnership. Both the Levack mine has a secondary egress for Vale's mine next door. And secondary egress it's one of those terms that we create in mining so that generalist people don't understand what we're saying. But the bottom line is any mine needs 2 ways out. And the first way out is your primary egress, and the second way out is secondary egress. So Vale is actually putting across a drift into the Levack mine that will give their workers, if there is an emergency underground, a second exit. But as part of that partnership, the 2 companies can share data on what's on my mind versus what's on your project. And it makes it very easy for Magna to see some of these footwall zones that Vale mines and where those zones will strike onto their project. And today Magna just put out a big press release, which they were drilling the keel zone at the Levack mine. If you look at the pressures, a lot of these intersections are 15 or 20% copper. And, they had these targets anyways, but I think they're more confident in these targets, having developed the relationships with both Glencore and Vale, and able to chat with the geologists on the other side, to realize that these targets may be more substantial. And what's really cool, and I'll take the McCreedy mine, because they also announced some results on McCreedy today, which is right beside Levack. And McCreedy is actually in production. Levack's on care and maintenance. In McCreedy, they announced, I think, 3 intersections, and they were all somewhere between 6 and 10% copper equivalent. McCreedy is a 1,500 ton per day mine. And if you do the math and say, even if these zones are small, and you mine 250 tons a day in this other mine, but you mine the 250 at 5% copper rather than the traditional grade of the overall deposit, that would add something like $37 million to the bottom line of the mine. Now, that mine on a normal time should average about $20 million a year in cash flow. So you can see the value of adding 250. I apologize. My dog even got excited by the $35 million in cash flow. But you talk about, so there's a lot of leverage to these higher grade footwall zones. And that's really a lot of what FNX did. They're just finding different zones now than they found 15 years ago.
You see, what's important for this part of the interview for our listeners is the depth of institutional knowledge that you have in the Canadian mining scene. It isn't just the it's the know who. The fact that you've been around these assets for 30 years. This is your second time around these assets. Tell me briefly about some other project that we ought to know about. Give me a second example of what you're going to do for us in the next 2 or 3 years in terms of making us money.
Well, I'll talk about a company that we just did a finance with, and it's not even in Canada, it's in Australia. It's a company called Saturn Metals. And Saturn Metals has a beautiful, beautiful deposit in Australia. The problem being is it's a heap leach asset. And I say problem not because there's any problem with heap leach. As you know, heap leach produces a significant amount of gold. If this was in Nevada, this would be a $200 million company. They've got a 2 million ounce deposit. It appears to have a very robust initial core to it, which, as you know, means when you do build the mine, you're going to get your capital back quickly, because the core, from our calculations, will have like a 0.2 to 1 strip ratio and good grade. But in Australia, they haven't built a lot of heap leach mines. And I remember they tried one in the, I think it was in the early 90s or late 80s, called Zapopan. It was Mount Todd deposit, and it didn't work. And it didn't work for some very real reasons. The ore was really hard. I remember looking at that, and the deposit itself probably needs a mill. But this one is very different. It appears to have very great leach kinetics. But the Australian retail investment community just doesn't understand the story, not because they're dumb, but they don't have 5 or 6 other heap leach stories to compare it to. And so the stock has always been mispriced. It's got the CEO is an ex-Newmont geologist who's a very accomplished geologist who is very cognizant with how much money Newmont makes on heap leaching. So he gets it totally. With our involvement, we've pushed him to use Caps Cassidy to do their study work, because Caps Cassidy is the heap leach guru company in Nevada that's been doing it. And I think Dan Caps has been doing it for like 35, 40 years. This one is taking some of our institutional model from North America and bringing it to Australia, where we can see the values that just aren't as well seen. And as this company becomes brought more into line with North American companies, we expect to see good things come out of this asset.
Well, Jonathan, once again, thank you for many decades of toil on behalf of investors. I hope that our audience understands something about value-added investing. Thank you, too, for your sponsorship of the Natural Resources Investment Symposium. I look forward to welcoming you personally to Boca Raton, and I would ask you to give the name of whoever at Dundee Corp, that people should contact and how they contact that person. If, as I think they should, they want to reach out to the company and understand before they visit you in Boca Raton, July 7th through 11th.
As I said last time, it's myself or Lila Manassa Murphy, our CFO. And my email address is jgoodman@dundeecorporation.com. And I don't know if hers is, I think, L Murphy @dundeecorporation.com.
That's all right. The first answer is the best. I like it when the buck stops with the boss. Listeners will understand one common thread with these interviews. Almost everybody that I interview is involved enough in their own company that they're the one that wants to talk to shareholders or prospective shareholders. Jonathan, once again, thank you, and I look forward to seeing you in Boca.
Thank you. Look forward to being there. Take care.